Expanded ranges and diverging yields. This is what we've started doing every Monday, and I want to continue to do it, Pete. Giving people little tidbits of the subscriber exclusive newsletter, right, and giving them some potential trade ideas or at least some information to go off of when trading a small exchange product suite that now is out to 8 products. We've got small crude oil as of last week. Got so much stuff going on here from the small exchange that we wanted to create a curated piece of content every Monday afternoon to let them know what's going on in the week. What say you?
I think this is great. You have really delved to the next iteration of content. I actually just printed it out about an hour ago. I was reading through it. Fantastic stuff. The subscriber weekly update is really powerful in the amount of information you get, and the amount of tradable information. So I think this is a great piece to kind of walk through everybody and really speak to the utility of this. So yeah, good stuff, my friend. I can't wait to get into this, actually.
I appreciate the kind comments. And before we get into some data, just want to give people the information here on the subscriber newsletter itself. A lot of people get this, just the updated commentary every week, but now it's out to 6 full pages. This is just half of one of the pages. 6 full pages, a bunch of data to go on top of the lower cost to trade that those of our small community are getting. If you don't already have this, go check it out. Subscribers.thesmallexchange.com, 50% off trading fees from the exchange, and a bunch, 6 pages every single Monday of updated data and exclusive content and giveaways that we're doing every single month for our subscribers. This next month, we are giving away some really interesting clothing options that might take advantage of the warmer weather here. So look for that. But to start out here, Pete, I wrote this piece for this week on the fact that you don't need an opinion to trade. And it is, I think, an interesting concept that maybe you can give a little color to, because I at the end of the day, got this from you. The idea of like, I'm going to trade metals, for instance. We look at gold and we look at the small precious metals product, and I don't necessarily need to formulate an opinion on whether gold is going to 2,000 or 1,500. I could just trade on the idea that it's going to neither in the futures, right?
Yeah, absolutely. And that's really what you want to do is not all of our trading decisions are based on directional bias. And I think that there's a lot of, we've talked about this, we draw on a lot of different strategies to form tradable opportunities. And it's funny because sometimes we talk about an opinion. An opinion is, and I think people take the term opinion to mean a directional assumption. Well, if you have an opinion, it means you have a directional assumption. Not necessarily so. So I think there's, I know I kind of glance over that piece. An opinion doesn't always come with the directional assumption. And I think that's what we're trying to hit on a little bit here is the tradable opportunity around the markets present to you where it's not like, well, I've got to be compelled to have an opinion to participate.
Yeah, absolutely. I mean, to me, having an opinion on gold, which is the example for this week, is like the guy who is, doing the interview from the pit, who's like, because of X, Y, and Z, gold is going to 5,000, or because of A, B, and C, gold is going to 0. And it's like that always, not always, but most of the time, that it helps nobody. Like it's not helpful at all. What is helpful is simply looking at the price action for gold over the last year, been as low as 1,500, been as high as 1,900, 2,000, and just saying to yourself, I don't have an opinion of this, but I'm going to trade the price action with the futures. I'm going to actively trade. And to me, it's this funny thing of like, though I am buying gold when it gets low and selling it when it gets to the high of that range, Pete, I never think of myself as having a directional trade on in gold, right? Like, yes, I am buying and yes, I am selling. Those are directional trades, but it's never like I'm buying because I think this thing is going to go way higher. It's just like, it's been trapped in this range. It just moved to the lower end of the range. And the previous price action has told me that this is a place where it bounces. Or recently, the last couple of weeks, every single time the SPRE futures, Pete, have gotten to $79 or $80, they've come off of it. And so while I'm selling when it's up there, I'm not necessarily taking, some strict opinion to market.
No, and I think that's a really important point because, as you said, when you're buying it, are you bullish? Well, it's a byproduct of it. I think we found, and one of the things we talk about is purely a directional assumption isn't enough to move the 50-50 bet. I mean, the directional assumption is where the coin toss comes in, and it's not the trade we necessarily want to have. So I think that what we like to do is move that ball from 50-50 to as far as we can with statistics, with the math on top of that, and taking advantage of realistic tradable opportunity within the ranges that the markets are giving us, rather than we've always mentioned this market should be, whenever you insert the word should, you should black tape that baby, click on to the next product, because there is no should in trading.
Yeah, no, to me, it's always similar to like the bread and butter for a lot of options traders, which is selling puts into down moves. It's like, I'm not necessarily buying stocks, but I am selling kind of this fear or this greater than 50-50 historical trade. And while you do have bullish deltas when you sell a put into a down move, you're not necessarily saying like, oh, I think stocks are going to go a lot higher. It's just like, oh, I know this trade historically works greater than 50% of the time, and so I'm deploying it. And yes, my deltas are showing up on my positions tab, but I'm not necessarily like making some, like gold is at $1,900. Right. It should be at $2,200. Like, that's not the way that we trade, because we use statistics like these. And it's funny, Pete, daily ranges are actually expanding in all markets at the small exchange, except for metals. Isn't that kind of funny that metals actually contracting in its range? And that's because it's been such a good range bound trade for us, which is just like, when it gets high, it tends to come back. When it gets low, it tends to come back. But range is expanding out to $1 plus in stocks and crude oil.
Right, which is, and this is why we want a diversified set of products to trade, is that, at $1.10, $1.15, I don't remember. Do you remember what the high was in that expected movement spree? Did we ever get out to, were we close to $1.50? I don't remember. I think
it was at most like $1.20, maybe $1.25.
Right. And that served us very well. Now here, we take what's realistic, and that's where these stats become so empowering for us in terms of building out strategies, is that we can't expect that $1.25 move right now. It's a non-standard day. It's outside what the market is giving us right now. But the diversified products afford us the ability to easily move into what is giving us that type of move. And that's an important piece as we roll out products into the small exchange. That is in and of itself a really important set of diversification and tradable opportunity.
And what is also interesting, it's Monday afternoon, and the SM75 sticks, but especially the SMO, the crude oil product, all near the upper end of that daily range, around $1 and a half there. Now we'll see what happens. Like, these markets could close above that dollar or so range that they've expanded to and continue to expand. Like, SMO can go from $1.50 to $2 and continue to see $2 days here in range. But that does already on Monday afternoon signal a potential opportunity, given that SMO is up almost $2 and the daily range is $1.50. We are seeing an outlier move to the upside in that crude oil product. And this is another nice piece that subscribers are getting for all products every single Monday. The forecast showing that SMO, the small crude oil product, well above the highs, the projected highs for this week, already getting back close to $66. Now, of course, it can settle outside of that range, but as has been the case in recent weeks, crude oil has seen big moves to the upside and then settling inside of that range. Now, Pete, I also put SFX on the board here because this, in my mind, is a market that has stayed within what you're seeing in front of you, 142 to 144, and I think is due for a little bit of an outside move. Of course, we're more of the mind that dollars should see a little bounce here. They're sitting at 2-year lows, but at some point, we have to trade outside of 142 to 144. That is a market that I think if it gets outside of this range, we could see it settle outside of that range, as opposed to SMO could stick inside of that. What do you think?
I agree completely. And that's again, another part of the useful tool. We talk about management levels and you know what, I like it. And again, using each of these for slightly different, we have an opinion in SFX and we have a position on, and I think, we're we've been dancing around this 143 level forever in terms of, are we going to, manage below that? And I've said 142.80 for any amount of time is where I get out. Now, the question becomes, okay, am I buying the 142.50s because I still like them? No, what this is telling me is that if we do trade that and I get out, where am I looking next to engage here? It would be sub 142. And if we close down there, it tells me then too, if I re-engage the market there, that chances are we're in the midst of finding a new tradable level. So I'm going to be mindful of that.
Absolutely. And another thing to be mindful of is
going with the barbells.
Yeah, the interest rate spreads here. And this is one that I used to really go away from. And I still am kind of a little hesitant on, but the small exchange has made this spread so small that I think it is worth looking at. This is, as Pete says, the barbell trade, or as we used to call it at my desk at the Board of Trade, the tub, the 2-year to the bond. The farthest ends of the U.S. Treasury yield curve here. And what you're seeing,
where you could drown yourself in a trade. Yes.
Well, because historically you would be matching.
Tell them how many twos you had to have on for 30.
Well, yeah, you'd historically be matching this market in the 2-year, the ZT future that moved like maybe $100, $200 per day, with the ZB future, which moved $1,000 to $2,000 per day. And yeah, you'd be doing 5 or 6 of the 2 years to make up for that 30-year. And inevitably on big days, the 2-year just doesn't move as much as the 30-year, and you would get killed. This is a little bit similar of that problem, where you have a 2-year yield future from the small exchange trading in yield, smaller and simpler here, moves about $10 per day, but the 30-year only moves about $30 to $40 per day. And because they trade in yield, so they are kind of on a level playing field there. And you can see that those differences of, the spread moving maybe $30, $20, $30 per day. Even looking at it today, I think it's out maybe $10, $15 today. A lot smaller and a lot more ripe for just ideas like this. Like the curve has, from 2-year to the 30-year perspective, steepened a lot over the last couple of months, given that 2 years have stayed near zero and 30-year yields have moved higher. Now, the question becomes, will we continue to see this steepening, or will those yields start to come back together, either as the 2-year rises or that 30-year comes back lower? I think this is an interesting one from either perspective.
Agreed.
I am more of the mind that at some point that 2-year has to come up a little bit and meet that 30-year. And I would look at that, long 2-year, short 30-year. You can look at it from the short 2-year, long 30-year perspective as well. But that's where I'm kind of siding with. And you can't, they theoretically trade on a 1-to-1 basis. If you want some extra oomph in that smaller 2-year there, you could do 2-to-1 or even 3-to-1 without getting too crazy. But this has been a great market to look at spread trades in, and still sitting at a historical extreme.